faculty for today, we decided that this can be one of the most important topics. To give a very small brief, if we separate the two words, one is the sustainable and the other is the reporting. Now, sustainability or the sustainable development is the need of the present without being able to compromise the ability of the future generation to meet our own needs. It contains two key concepts: the concept of needs, particularly the essential need of the world's poor, to which overriding priority should be given, and the idea of limitations imposed by the state of technology and social organization on the organization on the environment's ability to meet the present and the future needs. The concept is related to meeting the human development goals while conserving and protecting the nature, environment, and social ecosystem on which the economy and the society depend. The extraction or usage of the resource to meet the present human needs should simultaneously ensure that the availability of these resources for future generations to meet their own needs is not compromised. And why the reporting? Traditionally, the organizations consider the economic growth and socio-environmental parameters as mutually exclusive. And hence, economic growth was the only thing that the organizations used to disclose. But then, the chemical manufacturing companies started publishing their environmental reports since 1980s as a means of image building and the tobacco processing. I mean, we all are sure that we go through and see what the Dhariwal group does and how they try and do a lot of charity activities, etc. So the industry is also, the tobacco industry has also been following this suit in an attempt to attract investment. The disclosure of corporate information developed into non-financial reporting, such as sustainability reporting in the last 20 years, is a means of demonstrating accountability and transparency to stakeholders. India is one of the early adopters of sustainability reporting for listed entities amongst its various other global peers. In 2012, the requirement of BRR, that is the Business Responsibility Report, containing the ESG, the environmental, social, and governance disclosure, was introduced for adoption by the listed entities. Recently, in the year 2021, SEBI has introduced a new reporting requirement called the BRSR, the Business Responsibility and the Sustainability Report, with the intent towards having quantitative, qualitative, and standardized disclosure on ESG parameters. The BRSR is a notable departure from the existing BRR and set a significant step towards bringing sustainability reporting at par with financial reporting. Further, companies will be able to better demonstrate their sustainability objectives, position, and performance, resulting into long-term value creation. This is going to be an opportunity for all of us. And today we have with us Vivek Shah, who is going to tell us with more focus on how this can be developed as a profession for all of us. Before we hand it over to Vivek Bhai, I would request Karan to please introduce today's speaker, Karan Vora.
Yeah, thank you, Manish bhai. Yeah, thank you, President sir, and very warm welcome to all the participants. Today we have with us Mr. Vivek Shah. He is a partner in Ramanlal G. Shah and Company, Chartered Accountants, and he has 20 plus years of experience in assurance, consultancy, and value-added service in number of areas, ranging from banking to IT to chemicals, infrastructure, and he heads the sustainability practice arm for the firm Ramanlal G Shah and Company. He is a national rank holder chartered accountant. He is a qualified BRSR professional from IACI and Information Systems Auditor. And he has also been featured as a gem of CA profession in the publication by Ahmedabad branch of WIRC. So we would like to invite Vivek Shah sir, and to all the participants, you are requested to keep your microphone mute. And if you have any questions, then please write it in the chat box. Vivek would be addressing as the lecture progresses. So please welcome Mr. Vivek Shah.
Sorry, I was on mute. Thank you, Monesh bhai, Karan bhai, and Ronak bhai for giving me this opportunity to have a primary overview of the very, very fast changing and dynamic environment related to sustainability in India and all over the world. See, the primary objective of this lecture, I would not call it a lecture, but it's an interaction because we all are chartered accountants, most of us over here. It's an interaction where I would try and bring out the ways in which we as practicing CAs can leverage our practice in this field. That is the primary objective of this lecture. So we are not going to go into the details of a structured sustainability report or BRSR. It has 160 questions. Our institute is already offering a certificate course on that. That would run into hours and hours of lecturing and all that, academic learning. So I'm trying to cover the whole area of sustainability reporting, how it can help us in leveraging our practice, so that we all come to know at the end of this interaction that there are certain areas which are very, very fast developing. We can make use of them, and we can. Yeah, sorry, I think someone was on mute. So I'll start sharing my screen right now. Okay. Is the screen visible properly to everyone?
Yes.
Okay. So this is going to be the topical coverage of today's interaction. First, to understand how we can leverage our practice and how we can make use of this opportunity, we must understand in brief a little bit about the background, the context, and the evolution of this sustainability reporting, or we call it non-financial reporting. Then we will go on to point number B, the benefits which a company or any other organization can have from a sustainability reporting perspective. And the third part of our coverage would be the practice perspective, where it will be the practical application and making use of this evolving field. Now, we might all have heard of the United Nations Sustainable Developmental Goals, the 17 goals which were promulgated by the UN in 2015 in the Paris Agreement. This Paris Agreement was a conference held in 2015 where climate activists, climate scientists, environmental scientists, they all have been studying the human activities, the impact of human activities on our climate and the future of our planet, because this is the only planet we have, this is where we are going to live. So the impact of human activity since the last 40 years had been studied by the climate scientists, the environmental scientists, and they all came to a conclusion that there is a benchmark temperature rise which can be allowed, beyond which there will be detrimental effects on human life all over the earth. So that was taken very, very seriously by the United Nations, and to make the whole world a more sustainable place for us at present, as well as for the posterity, they came out with 17 targeted goals, because there were a lot of ideas regarding sustainability, climate change, deterioration of natural habitat, so on and so forth, since the last 30-40 years. But that was the first time when the United Nations took it up and formalized it in the form of the Paris Agreement Charter. India was one of the nations which was a signatory to the Paris Agreement, and these 17 goals, we can go through them one by one. First is no poverty, the second is zero hunger, third is good health, well-being, education, gender equality, clean water, sanitation, and so on and so forth. The 13th would be climate action. So basically, all the nations, the 193 nations, they agreed that we will set national developmental targets and national developmental goals based on these 17 SDGs. So what happened is that India, being a signatory to the Paris Agreement, India set forth its own goals in the form of national voluntary guidelines, which are now converted into the Ngrbcs. They are called the National Guidelines for Responsible Business Conduct. So India, the Niti Aayog at that time, they set up 9 principles. We will go through the principles of the NVGs or the Ngrbcs a little later in our presentation. So India said that since we have to contribute as a nation, as a signatory to the Paris Agreement, we will start implementing these 9 principles, and we will ask all our organizations, the commercial organizations, corporates, public entities, and the public at large, as far as possible, to subscribe to these goals and to implement these goals as a measure of conducting their own activities, commercial activities, business activities, and all other activities put together. So this is how the Niti Aayog put it forth for India. Now, going ahead, we first need to understand the concept of sustainability. Like Monish bhai rightly said, there are various definitions of sustainability. We all understand what sustainability means, but to make it into a formalized framework, there had to be a definition put forth, which had to meet the consent of all the signatories to the Paris Agreement in 2015. One definition is meeting today's needs without compromising the ability of future generations to meet their needs. So what we do today should not be detrimental to the generations to come. The second widely accepted definition is the ability to sustain. That our activities, the way in which we conduct our activities should be such that our planet can sustain them, because our Earth is a harmonious, holistic ecosystem. What we do over here has an impact over there also. Everything is connected at certain levels. So from that, the third definition comes, it's a harmonious existence of humans and the environment. So this is the whole concept of sustainability and how it came, how it was developed, and why it has come and why it has become so important for India. Now, sustainability basically represents a transition in thinking, a transition in approach, a transition in bases and practices, values, inclusivity, and compatibility. If we remember the CSR provisions in our Companies Act, they came to India in 2012, 2013. Since then, every company has been allocating 2% of their average net profits of the last 3 years to CSR activities. That was also a part of the NVGs, which were promulgated at that time in 2012 and 13. So the companies were asked at that time by the government, the Niti Aayog, that look, this is what we have promised to the whole world, and you are going to participate in that, and you are going to help us in achieving our commitments to the world at large. Now, if we look at the changing mindset, earlier we had learned, and the business paradigms were that we will maximize profits for shareholders, return on investment. bottom line. Those concepts were the original building blocks of conducting business. Earlier, the definition of what is a business, people used to say the business of business is conducting business. That was the old paradigm, the old concept. Now, after the concept of sustainability started gaining ground all over the world, people started understanding that we are not functioning alone. We are not functioning in isolation. The concept of shareholders and owners, it started turning into stakeholders. Stakeholders may be internal stakeholders and external stakeholders. So stakeholders are those people and those entities and parties which are connected directly or indirectly with a business, with a commercial or non-commercial entity. For example, if we take the example of an FMCG company, even the ultimate consumer of their products like you and I, we all are their stakeholders, because what they do and how they function and how they make their products ultimately matters to us. We are all affected by that. The second old concept which has shifted was from profits to value creation. The earlier concept was that we need to make profits. We need to increase our profits, our bottom lines, and give the maximum return possible to our shareholders. That has shifted, it has enlarged to value creation. Business must function in such a manner that its activities creates value for all its stakeholders. That is the second major shift in a business paradigm. The third is from linearity to circularity. Linearity is, I have a raw material. For example, I am a manufacturing company. I have raw materials. I put it in my process. I have an output. I have my finished product. I sell it in the market, and my business is over. That's all I have to do. So that was a linear pattern of business activities which was happening. The focus was from going from point A to point B, procurement of raw materials to selling your ultimate product in case of a manufacturing company, for example. Now the focus is on circularity, because what you finally sell to your stakeholders will ultimately have to come to you. Take, for example, a recycling plant. Now, cold drink manufacturers like Coca-Cola or bottled water manufacturers, they give us their products in plastic PET bottles. Okay. Now, what happens to those bottles? Who is responsible for the disposal? Who is responsible for the ultimate end? The company which is creating those products is now responsible, because it has a responsibility towards all its stakeholders. They just cannot now afford to ignore the stages after their sales. They have to undertake activities to get those plastic bottles back, to have them recycle either on their own or through a professional recycling company, and get all that plastic back to them and again turn it into a raw material. So that is a circularity of operation. I'm just giving an example so that we can have more clarity on what is circularity. The fourth major paradigm was segregation. We had we had very separate compartmentalization for shareholders and owners, employees, the consumers, your suppliers, your manufacturing partners, your JV partners. They were all segregated. Everyone was looked upon as a separate party with separate objectives, with separate goals and separate missions. Now, this whole framework says that everything is included as a part of your business activity. All your stakeholders are included. You can't ignore the well-being of one stakeholder at the cost of the well-being of the other stakeholder. If one stakeholder is affected or if one stakeholder suffers, it cannot be at the cost of enriching the other one. So it has to be a balanced activity where all stakeholders are benefited mutually without detriment to each other. Now, coming to what is ESG, these three letters represent environmental parameters, social and governance parameters. Now, in environmental parameters, this is just a small example of what these parameters are. There will be n number of other parameters also. This is just for our basic understanding. The resource management, the emissions reduction, environmental accidents, and risk mitigation. Now, you see, what has happened is that we saw in this winter, since the last 2 months in Ahmedabad in Gujarat, we had rainfall 3 times. I fail to remember a last winter when we had rainfall for more than 1 time. Every couple of years we have one unseasonal rain in the winter, but this time it rained 3 times. We had a very foggy Friday morning today. It's cloudy right now. It's foggy. I mean, these changes, people, the environmental scientists, the climate scientists, they all attribute to climate change because of the damage that human activity has done to the environment. So when a business, when a manufacturing or a service organization or a government entity or an NGO conducts its own activities, it has to look at the parameters it affects on the environmental aspects. The first would be resources. We have seen that there has been a lot of resource scarcity in certain sectors of manufacturing in the last few years. Cost of manufacturing has increased tremendously. Certain resources have become very hard to find. So how the resources are managed in an environmentally friendly manner is a part of the E of the ESG. The emissions reduction, of course, the accidents, the environmental accidents, for example, oil spills, the oil refineries, they have major oil spills. Very recently in 2002, I think British Petroleum had a huge oil spill in the Gulf of Mexico. After that, it had to shut operations. Risk mitigation. These are all new types of risks that the commercial and non-commercial entities are now facing. And these risks are imminent. It's not that we are going to see it after maybe a decade or 2 decades from now. We are going to see it maybe 2 or 3 years from now. The social aspects, the health and safety, human rights, community relations, and the supply chain monitoring. And the governance would be the way in which the policies, the procedures, and the governance of a company is handled, the governance of an organization is handled, how accountable, how transparent it is, how does it affect, how does it impact and take care of the rights of all the stakeholders involved, what is the vision, what is the temporary, permanent, long-term, short-term vision of a company. All those things matter now. I'm sorry. Yes. So I mentioned earlier that the Paris Agreement of 2015, it laid down 17 SDGs, which were adopted as NVGs, the National Voluntary Guidelines, and now they are renamed as the National Guidelines on Responsible Business Conduct, NGRBC. So the Niti Aayog at that time laid down these 9 principles. So the first principle is governance. It should be transparent and accountable. Second is safe and sustainable goods and services. Your products, your services should be sustainable. They should conform to the principle of circularity we earlier saw. Employee well-being. All your employees are basically your stakeholders. They are your internal stakeholders. Not only the shareholders, but they are also a part of your stakeholders. In fact, when we look at the concept of stakeholders, stakeholders may be anyone from the governments, the regulatory bodies, the shareholders, the employees, the customers, the suppliers. Everyone is a stakeholder of a company, of an organization. So when you say how the employee well-being came into this picture, because of the concept of inclusivity, which we saw in the earlier slide over here. Instead of segregation, we should have inclusivity. Stakeholder engagement and well-being. So it says the principle that the well-being of all the stakeholders has to be kept in mind. You should have a balance You cannot have one stakeholder enriched at the cost of the other stakeholder. The fifth is obviously the human rights protection, which directly comes out of one of the United Nations SDGs, one of those 17. Sixth is the environmental sustainability and conservation. Seventh is responsible public and policy advocacy. You know, there are a lot of trade forums like GCCI, like FICCI. I mean, I'm just giving a few examples. Trade forums, industry forums, they are all responsible for representing the interests of industry of a particular sector with the government. So a company as a part of that organization, a part of that association, how does it impact the policy advocacy? How is it responsible for advocacy? And what are its policies and practices to this effect? That has to be covered under principle number 7. Inclusive growth, as the name suggests, all the stakeholders. For example, I'll give you an example. A handicraft manufacturing company, it acquired, it went to the tribals of northeast of India, and it acquired the rights from those tribals to manufacture their own type of cloth, which they were ethnically, indigenously manufacturing. It started marketing that. It got a copyright for that, and then started marketing. So this eighth principle says that if you have acquired an intellectual property from the tribals of Assam or Meghalaya, the Northeast, then you have to make sure that you not only give them compensation, but you also take care of their well-being and their publicity. All those aspects have to be taken care of. You give them due credit. It just does not end by purchasing a copyright, giving them compensation for copyright. So this eighth principle is related to your inclusivity instead of segregation. Earlier, segregation would have said that you purchase a copyright, you give them purchase consideration, end of story. But no, you have to give them due recognition. So now these companies have started saying the credit, the idea goes to the tribals of Assam. For example, the ninth principle is consumer well-being. Consumer well-being, of course, you cannot have manufacturing of products which are harmful to the consumers, to their ultimate consumers, without warning them. This principle is more or less specifically there for certain types of industries such as tobacco, such as alcohol, explosives.
કાલે આપણે મળીએ ને એટલે પ્રોગ્રામ ગોઠવી દઈએ.
So basically, these are the 9 principles of the NGRBCs, and this is the basis of sustainable reporting in India. So I have tried to map the 9 principles into these 3 E, S, and G parameters, because when we say, we might hear a lot of things, ESG and BRSR and NGRBCs. Now, how everything is connected and how things are logically put together is what we need to understand. The principle number 2 and principle number 6, they are part of the environmental parameters, the product life cycle and environmental impacts. Social impacts, the employee well-being, principle 3, P5, the human rights and inclusive growth. And the governance has principles P1, the ethics, transparency and accountability, shareholder engagement, policy advocacy, and consumer well-being. So as a final conceptual understanding of how ESG, how NGRBCs, and how the SDGs connect with each other, this is a chart. On the left, we have a column showing 1 to 9 principles. On the top, we have the columns for the first 17 SDGs. The green areas, the green squares, shows how each principle of the NGRBC is mapped alongside the principles of the SDGs. So for example, principle 2, that is product sustainability, that is linked with principle number 2 of the SDG. This is something which you can study at depth because this presentation will always be shared. I'll just give you a minute to just understand, and let me see in the meanwhile if we have any questions. Karan bhai, do we have any questions right now? Because I have shared my screen, I can't open the chat box. Let me see.
No, I don't see any.
No questions come up. So
No questions still. No.
Not yet. Okay. Okay, then let us
And
go.
it is quite self-explanatory, so I think we can go.
Exactly. Till now, I think everything is pretty self-explanatory. We have understood. So
Correct.
this has been the evolution of sustainability reporting in India. The NVGs came, then SEBI through its LODR. It said in 2012 in clause number 34, I think, if I'm not wrong, the BRR, the Business Responsibility Report, was made mandatory as a part of our financial statements. Now, we might have heard the terminology called integrated reporting, IR. That is not only a framework reporting, but it also signifies that when you present your financial statements to public, the non-financial reporting in the form of a BRSR or any other reporting format has to form part of your statements. So if we look at balance sheets, published balance sheets of major companies in India, after the management disclosure and analysis section, or in some cases after the CSR disclosures, we have the BRR report. And from this year onwards, from 21-22, some companies have also started publishing the new format, the BRSR, because right now it is voluntary. From the next financial year, it becomes mandatory for the top 1,000 listed companies. So this has been the overall evolution of sustainability reporting in India. So, as I said, SEBI has made it compulsory to make this as a part of your annual report through clause number 34 of the LODR. Clause number 35 has been recently introduced right now. It is related to the risk management policies, and when specifically says that the board has to form a committee related to risk management. So the clause 34, it clearly says, it has also received an amendment recently. The earlier clause 34 was saying that you have to include the BRR as a part of your annual published reports. And now it is just simply saying that now you have to publish it in the form of BRSR, because now it becomes mandatory. So the BRSR came from SEBI on 10th May 2021, the new format. The new format is in two parts, the BRSR comprehensive version, and the second is the BRSR Lite. So the smaller companies who are quite new to this whole reporting framework, they can adopt the BRSR Lite, and companies which have been well established into sustainability reporting, they can either go forward with their own erstwhile reporting formats and publish BRSR also, or they can go on only with the BRSR. So when we say how many frameworks are there for sustainability reporting which a company in India can adopt, the first is the BRSR, of course, which has been customized, so to say, in the Indian context. The second is the GRI, Global Reporting Initiative. The third is the TCFD framework, the Task Force on Climate-Related Financial Disclosures. The fourth is the Integrated Reporting Framework, IR. If you see companies like Mahindra and Mahindra or some other companies in the top 50, top 70 listed companies of India, you will see that they have been since years reporting on the IR or on the GRI. So because GRI at present is the most widely accepted and used framework for reporting all over the world. So companies which are listed in other countries on the London or New York or Singapore Stock Exchange, they generally prefer to adopt the GRI or the IR framework for easier understandability. SASB has also come out with a framework, and the newest framework right now would be from the TNFD, that is the Task Force on Nature-Related Financial Disclosures. So as a company in India, we have an option, they have an option rather, they can choose to report on either of these formats or on these frameworks. They are free to do that. But the BRSR is a mandatory requirement. Even if a company reports on GRI framework, on the GRI standards, it still has to fill up the BRSR report. It can cross-reference the GRI report with the BRSR, but the BRSR has to be published as a mandatory requirement. So now we come to a very, very brief, quick understanding of the BRSR format. The BRSR format is split into 3 sections. The BRR, the earlier version, it had 4 sections, but now everything has been consolidated logically. The section A is on general disclosures. So these general disclosures would be of the nature which are already published in XBRL format by a listed company. So these are directly coming out from, most of them. They are, for example, the name of the company, the registered address, all those things. There are about 20 to 23 questions in the general disclosure section A. The section B is related to the management and process disclosures. Now, what is management and process disclosure? It is related to the governance aspects. Does a company have policies in place to address each of the 9 principles of the Ngrbcs? Yes or no? And if no, you have to explain. If yes, give links or URLs of your company policies related to each and every concept. If you, after this lecture, if you just have a look at any of the BRSR or BRR reports published by the top listed companies, you will come to know exactly how they link, how they give URLs, what they report. And the section C is performance-wise disclosures, principle-wise performance disclosures. So it will be having questions on each and every one of these 9 principles of the Ngrbc. Now, the SEBI and the MCA understood that since this is going to be a new reporting framework, not all the companies would be very well versed or grounded or equipped to report and to respond to each and every question. So they divided the section C, your performance-wise indicators, your disclosures, into 2 indicators: the essential ones, the mandatory ones, and the leadership indicators. So, as a rule, as a mandatory requirement, the company has to report on the essential indicators. And with a higher level of maturity in reporting after a couple of years, if the company reaches that, they can also start adopting the leadership indicators. This is the concept at present. It will definitely start evolving and changing, because once companies start adopting this reporting requirement and reporting framework, they will come to know how to go about it, what to do. So it is highly likely that some of the leadership indicators might turn into essential indicators going into the future. Now, what is ESG? We have already covered this. Now we come to the second section of the presentation: why a company or an organization should go for ESG. Now, if we recollect what Monish Bhai, our president, said in his introductory speech, that the general mindset of any person would be, I will do it when I am forced to do it, right? It is going to be mandatory from 1st April 2022. Why should I start addressing it right now? I still have more than a year to go. That is a very, very natural general mindset. So when we try and approach the companies that they should implement non-financial reporting, sustainability reporting, they will ask you a question: why should we do it? We still have more than a year to go. So why go forward with it right now? We have a lot of other compliance issues, GST issues, this, that, lot of things to take care of right now. We'll cross the bridge when it comes. So we must understand, to address this problem, we must understand what type of benefits the company is likely to have if it starts adopting non-financial reporting, sustainability reporting. I have clubbed these benefits into 3 categories. The first is the financial benefits, the second is environmental benefits, and the third is the social benefits based on the parameters of ESG. Now, a company, the general perception amongst the investors, the external stakeholders right now, it is evolving and it has matured to a very, very high degree right now. companies which are adopting non-financial reporting, sustainability reporting, they are getting a better credit rating, they are getting a better credit score, their cost of capital, their cost of finance is reducing. They are getting reduction in basis points on interest rates. This lower cost of capital is a big financial benefit which any company can take advantage of if it starts sustainability reporting. Second is the risk mitigation. There are several types of risks, and this is an entirely new category of risk which a company is going to face, it has already started facing. Risk mitigation, the environmental risks, the governance risks. I mean, just to give you an example, a company which has one manufacturing facility, they are planning to expand, they are planning to have another facility at another location, either for backward integration or for forward integration or whatever purpose. Now, they have acquired land. They have conducted all the feasibility studies, techno-economic viability studies, everything has been done. And they have put forth the proposal to the bankers, to their investors. We are going ahead with it. One thing which they have not understood, or one thing which they have not studied, is for example, the groundwater situation in that proposed facility. I have come across cases where this has actually happened. They may see and they may feel that we have water over there, we will get a good source of water, but there is not enough water to sustain their activities after a couple of years. This is a risk which has never been looked into in a traditional sense, in the traditional mindset. And this risk has to be addressed in any decision making which the company makes in the future. Integrated shareholder value creation. It's a self-explanatory thing. I think we have already covered. Tax benefits and subsidies. Now, we already had a lot of tax benefits in the Income Tax Act for backward area developmental projects and all those things. Now, in the future, in a couple of years, we are envisaging in this field that we are going to have carbon taxation. It has already started in countries like Sweden and Netherlands. So every country under the Paris Agreement, and now recently under the COP26, which happened last year in Glasgow in November, each nation has been allotted a carbon budget. You cannot emit more than that. If you emit more than that, you have to pay a tax to the United Nations, to all the signatories. So that is a carbon budget which has been fixed for every nation. In turn, the carbon budget has to be allotted to all the companies and the corporations which are functioning in a commercial manner in a country in India. So if a company A has been given X tons of carbon emission per year, it cannot exceed that. So if you exceed that, you will be taxed. It's a carbon tax. On the contrary, if you save on that budget, you generate CERs. You save tax. That is a very, very likely tax subsidy and a tax benefit and a punitive tax which is likely to come very, very soon to India. Positive impact on share prices. We have seen, my friends, that companies with good ESG ratings and with good ESG disclosures, their share prices on the stock markets are booming like crazy. We have also come across ESG mutual funds. The mutual funds invest in companies which are having good ESG disclosures and good ESG rankings. Higher business valuations. We were just discussing before the seminar started today. Valuation of a business, valuation of an asset, everything will be impacted by the sustainability risks that a company is going to face. For example, in a merger and acquisition, the target company, it has been valued. Due diligence, the legal, the financial due diligence has been conducted, but the environmental sustainability due diligence has not been conducted. 5 years down the line, the company is facing a risk wherein the very going concern, the basis of that company is going to get eroded. It has never been looked into. So that is going to affect the business valuation on a higher or a lower side. Now, cost reduction. There have been huge technological advances where adapting environmentally friendly practices, business practices, production practices has reduced costs. There have been cases, documented cases, I have also come across them in our own practice, that cost reduction to the tune of 15 to 17% has taken place by adopting environmentally friendly practices. And goodwill and market visibility. Now, if a company says, I'm environmentally stable, I adopt good sustainability practices, as a consumer, now people are becoming aware. Even children of our generation, they are becoming aware that we must save the environment. They want to purchase products or use services which are environmentally friendly. It affects the market visibility and the goodwill of a company. These are, in general, very broadly, the financial benefits we can. I mean, each of these topics is a subject of a separate webinar. I would really tell you. I mean, this is like an ocean. I'm just covering one drop in the ocean so that we can have a basic understanding how it will lower your cost of capital. For example, we can have interaction on that for more than an hour. It's a separate subject altogether, but this is an overall bird's eye view of the financial benefits which we can use in our armory to convince our clients to address their concerns. The environmental benefits, resource management, the resource availability, circular economy, risk mitigation. These are the environmental risks I'm talking about. Sustainable businesses, reduced insurance premiums. Now, insurance companies, they are also looking at the ESG parameters, the ESG ratings of a company. They say that if you have a fire hazard risk, for example, not the general fire hazard risk, mind well, the fire hazard risk because of some kind of a forest fire or a tropical storm, that is a risk which you have not addressed. So we will increase your insurance premium on your assets. Or maybe if you have mitigated those risks, we will reduce that. And this is an incentive. Again, this is a big cost and a big risk which the companies can take care of. Environmental compliances. There are a lot of environmental compliances based on specific industry type, and these environmental compliances of late, they are becoming more and more stringent. The government is becoming very, very particular about environmental compliances. Reporting on ESG, the sustainability journey, is one way to ensure that your environmental compliances are in place. You are not non-compliant in any manner. And I will give you an example over here. I recently visited a bank. We had been called for some discussions on this. They had sanctioned a project, a hotel project. They had given a construction period, a moratorium. Construction period was supposed to be around 2 years. So there was a moratorium. They had disbursed a loan upfront. It was a term loan. Sorry about that. And after that, they did not get the environmental clearance for building a hotel at that particular site. The company, the hotelier, he was trying to get the clearance, pursuing very hard, but ultimately they did not get it. And the very third year, they could not service the loan because they did not have any cash flows. Their business did not take off, and the loan turned into an NPA. So the bank would obviously have thought about it, because at that time, when the credit assessment was done, the scrutiny was done, and the term loan was sanctioned, they had not looked into these parameters. They had not carried out a risk assessment on sustainability, on the possible impacts which this hotel is going to face. Social benefits. Now, employee well-being is something which is the central theme of ESG as far as the social benefits go. A happy employee is a more productive employee. That is the old age saying, which we all know. Happy employee is a more productive employee. Increase in productivity. better. I mean, I'll give you an example over here again. We all know what is a green building. We have heard about the concept of a green building. Having a green building has documented increases in employee productivity as compared to a similar non-green building because of various factors: better ventilation, better working environment. I mean, nowadays, employee well-being, the social benefits are such that people look at the ESG, the job applicants, they look how your employee well-being measures are, what policies, what practices you are adopting for the well-being of an employee. This helps in attracting the best talents. Ensuring EHS factors. So the EHS, the environment, health and safety, I mean, this is all a subset of the ESG gamut as a whole. Reduce downtime. You have fewer accidents. You have fewer incidents, which reduces your downtime in your production, in your operations, in your activities. And the last is your human rights and supply chain. Obviously, I mean, this is more or less the coverage of our social benefits. I mean, so coming back to the financial benefits, as I said earlier, each and every thing can be covered in a lot of detail. When we go to our prospective clients, we have to explain them that these are the benefits and these are things which you should do in your own interest. Whether it becomes mandatory or not, or when it becomes mandatory, that does not matter. Now, coming to the last section of our presentation, all this is okay. So how do we leverage this into our practice? Do we have any questions till now? I think there is one in the chat. Do we have any questions till now? I think I'm not able to open the chat box right now from here.
No, I don't think. Monish?
Karamit, I think there was one in the chat.
Yeah, no, that is written by me only.
Okay. Okay.
I don't think I see any questions. I think Monish is not there on the screen.
Okay.
I'm there. I'm available.
Monish, can you mute everyone else?
Yeah.
And for participants, if they have any questions, please write it in the chat box. Otherwise, you can ask them at the end also. It's up to
No
you.
problems. Anytime. One common, I will pose one question, which I have been facing many times, several times. And it is a very, very natural, logical question. When we are already doing CSR activities, so what is the difference between this CSR and ESG? So there is I mean, it can be answered in a many number of ways. The way I prefer is that the whole difference is in the context and in the perspective. CSR is focused on how a company spends its profits, while ESG, sustainability, is focused on how a company earns its profits, how it generates value. And CSR is concerned with how it spends that profit and how it spends that value which has created. So this is the fundamental difference between ESG, the sustainability, and CSR. CSR is a part of ESG. It is part of the whole gamut of ESG. So fundamental difference: how you make profits, how you make value, how you create value, how you include people, how you include stakeholders. That is sustainability and ESG. While how you spend your profits, how you spend the value which you have created already, that is a part and the subject matter of CSR. Okay, so how we can leverage our practice through all this? The way in which we can leverage depends on internal stakeholders and the external stakeholders. So what are internal and external stakeholders? Internal stakeholders would be people and the parties which are connected with an organization included in their own organization. For example, the shareholders, the owners, the promoters, the directors, the employees. These are all the families of the employees. These are all the internal stakeholders. While the external stakeholders would be the investors, the JV partners, the government, the regulatory bodies, the environmental agencies, the income tax department, so on and so forth. These are all the external stakeholders. SEBI, for example, it's an external stakeholder. The Ministry of Corporate Affairs, it is an external stakeholder. So this is the basic difference between internal and external stakeholders. Now, why we need to understand this is when we want to start practice on sustainability, the areas that we cover and the parameters that we address will depend on which stakeholder requirement we are trying to meet and which requirement we are trying to address. Are we addressing the external stakeholders or are we addressing the internal stakeholders? So that boundary has to be created while we enter and while we start practicing on these lines. Now, this and the next slide, it will cover a few of the broad areas of sustainability practice. I mean, this is not only related to India, it is related to the whole world. It is applicable everywhere. Sustainable finance. What is sustainable finance? Sustainable finance would be basically a financial perspective, a person or an equity partner bringing in his funds to a company which meets certain sustainability parameters. They are saying that, see, the traditional, when you present a project report to a prospective investor or a venture capitalist fund, the traditional perspective would be to look at the IRR, to look at the payback period. If the IRR is not conforming to certain benchmark, then you have a certain different type of negotiation and so on and so forth. A sustainable finance investor would be primarily looking at your numbers, at your payback period, at your IRR, and also equally important, they would be looking at your ESG parameters, the risks that you are facing, the risk mitigating practices that you are going to adopt, how you are going to satisfy each and every parameter of your sustainability journey. That is basically a sustainable finance perspective. It is developing by leaps and bounds, and we would have also been, if you reading the newspapers, the Economic Times, the Business Standard, any other business news, every day there has been some news, small or big, related to sustainable finance. The second would be the impact investing. Now, what is impact investing? Impact is the impact created by a company, by an organization through its sustainable practices, through its sustainability practices. So what are the positive impacts created by them? What are the negative impacts created by them? So a company who is indulging into impact investing, they would be looking at the positive impacts which a company is creating. So for example, if you are having a better ESG score, the impact investor would be highly likely to favor a company with a better ESG score, or maybe have better terms or better commercial terms with that company. That is impact investing. So there is a small difference between sustainable finance and impact investing. Sustainable finance depends on the sustainability parameters, the risks and the assessment of that risk and the mitigation of that risk. While impact investing is a positive way to look at it, how you are having an impact through your activities. Are those impacts negative? Are those impacts positive? Now, green bonds. We might have read very recently various countries coming out with billions and trillions of dollars of green bonds. Now, what are green bonds? So green bonds are basically climate related parameters are set by a company, by an issuer, and they say that we are sitting in 2022, so by 2035 or 2030, any time horizon, we are going to reduce our carbon footprint by so and so metric tons, or maybe we are going to get carbon neutral, or we are going to achieve a net zero transition, we are going to get net zero, or maybe we are going to get carbon positive by 2035. So based on those targets, they approach the market, they issue bonds which are called green bonds. So if the company does not achieve those targets by that year, by as promised, they face a penalty. And if they do achieve that, the green bond holders are going to get returns anyway. So it is a way of attracting the market participants by issuing green bonds, by showing and by promising and by committing that we are going to achieve so and so targets in terms of carbon neutrality or carbon emissions by such and such a year. It's a time horizon. So these are called green bonds. Next would come ESG funds. I mean, these I'm covering because if we are in the practice of finance and investment advisory, we must know the latest developments. We can advise our clients, our investors, and our portfolio participants that you can go for companies which have issued green bonds, which are into sustainable finance. Now we come to ESG funds. Now, what are ESG funds? ESG fund is basically a mutual fund. A mutual fund based on companies which have ESG targets. Many companies in India and abroad, they have announced already that we are going to get carbon neutral by 2040, or we are going to get carbon neutral by 2035, or we are going to reduce our emissions by so and so metric tons per annum by this year. So companies which have already announced these targets, companies which are already on their way, well into their way into the sustainability reporting sphere, they target these the funds, they target these companies, they invest the participant money in these companies, they create a fund that is called a ESG fund. It's basically a mutual fund. It works on the same principles, but the companies which are targeted are those companies which have green and sustainability targets announced in the public domain. Credit ratings. As I said earlier, there have been many credit rating agencies in the world, notably MSCI, or the first was the DJSI, the Dow Jones Sustainability Index. Now it has created many sub indexes based on industry category, the DJSI. I mean, MSCI is another top world rated credit rating agency. India also, CRISIL and ICRA, they have come out with ESG ratings. Now, what are credit ratings based on ESG scores? So, credit ratings, as we already know very well, they are based on risks and the mitigating policies and practices that a company adopts. There are various methodologies for credit ratings. We need not go into the details of that. So now those credit rating agencies, they have created ESG ratings based on the ESG parameters and the sustainability reporting outcomes which a company has already published. So for example, if a company has come out with a sustainability report based on GRI or based on IR, and it is a huge emitter of carbon, and it has done nothing to do anything about it, it has not addressed that problem, it will have a downgrading effect on the credit rating. So lot of us are working either for credit rating agencies or with credit rating agencies. So we need to understand the methodology they adopt. We need to advise our clients that when you are rated, your ESG performance will also be taken into account, and that will be something which can hurt you, because credit ratings, if they go downward, your cost of finance, your interest rates, everything is going to go up. You know, we all of us know very well. The second, the next would be initial public offers, IPOs. Now, like I said earlier, one of the financial benefits of sustainability reporting is goodwill, market valuations, and business valuations, market visibility. People all over the world now are highly educated, highly aware citizens. They know a company which is into sustainable practice and into sustainable operations, working in an environmentally friendly manner, taking care of its stakeholders, of its employees, they are going to be viewed favorably by the market participants. So when a company, maybe a year or 2 years down the line, is planning an IPO, this would be the right time for them to start their sustainability journey, start reporting on it. We have maybe 1.5 years. It depends on the horizon that they have. So reporting on sustainability parameters is going to fetch better valuations for sure in the IPO. And SEBI has already announced that it is coming out very soon with ESG disclosure requirements in a prospectus. Another example of how the regulatory bodies are taking this very seriously for the share valuation and the equity valuations. London Stock Exchange, New York Stock Exchange, and Singapore Stock Exchange, they have already come out with issuer guidelines for ESG reporting for all the listed companies and those companies seeking listing in those stock exchanges. So this is going to be a very major area. Coming then to mergers and acquisitions. Traditionally, when there is a transaction deal taking place, there is a due diligence which is conducted. That due diligence focuses primarily on the financial aspects, the legal aspects, and the HR aspects. The companies now also face, like the example which I gave, the companies now also face sustainability risks, and the due diligence exercise must also cover the sustainability risks that a company is going to face in the future, because that will directly have an impact on the valuations. Direct lending, like I said, when banks conduct valuations, then it is also a part of your merger and acquisition. Sorry, I forgot to take it. Direct lending, when banks are approached by a promoter for a project with a project report, the banks conduct a credit risk analysis. They conduct all types of exercises. They do analysis in lot of ways. RBI has a very, very rigorous and well laid down structure of credit evaluation and ongoing credit monitoring also. But as of now, we do not have a formalized framework for evaluating the sustainability, environmental related risks when a credit proposal comes on the table of a banker. That is not yet there. And when we say that we are into the practice of sustainability, we also do risk analysis, the risk assessments, and the risk mitigating factors which a prospective project is facing. This could help banks, this could help financial institutions into the lending industry. Now, coming to the practice avenues. Now, these were the areas, the earlier ones which we covered, these were the broad areas. So now I am going to cover the practice avenues, slightly more focused. The first avenue is sustainability and supply chain advisory. Now, this is something which we can help our clients in a very, very positive manner. It's a big value added service which we can have. Supply chain advisory, how to shorten their supply chain, how to make it more sustainable. This is one area which we can address. Second is policy formulation with relation to the Sdgs and the Ngrbcs. Now, a lot of us are into formulation of the SOPs, for example, for various areas of operations, the standard operating procedures. So policy formulation would be an adjunct to what we have already been doing. We can help our clients or prospective clients making policies and helping them adopt those policies from the sustainability reporting point of view. For that, we must have a complete, very in-depth, detailed understanding of the sustainability reporting framework which a client is adopting or going to adopt. Facility designing. Now, this is another area where we can render our very good services. If we have a multidisciplinary, multifunctional team with us in our firm, in that case, we can also tell our clients that we will be able to guide you and help you in design of your factory unit, factory building, administrative building, your corporate office, so that it conforms better with your EHS parameters and with your ESG parameters. So this is something which we can develop. Non-financial reporting and assurance. Now it goes without saying, we can help our clients in making the BRSR. Just taking an example of BRSR, we can help our clients draft the whole report. And as of now, at present, audit of that BRSR is not compulsory, but definitely it is going to be compulsory in the future. This is what we all envisage, because you cannot have a company publishing data in the public domain without it being externally assured. So audit and reporting, that is also going to be, I mean, if we take a comparable example, assurance of a BRSR report would be like a statutory audit of a balance sheet, and helping them prepare the BRSR would be like helping them, I mean, giving them accounting advisory services. Climate change and energy. We can advise and consult our clients in helping them meet their carbon neutrality targets, their energy efficiency targets. Again, this would require a multifunctional, multidisciplinary team. Outcomes measurement. Now, what is outcomes measurement? So, the company would have already announced that we are going to go carbon neutral. Now, I keep repeating carbon neutral for a very simple reason, because most of the companies at present have come out with only carbon neutrality and emission reduction as their targets. They might also in the future come out with other social targets. So outcomes measurement, they may have any target based on any of the E, S or G parameter. They say that this is our benchmark, this is our target which we want to achieve in the next 5 years. So it is not going to happen overnight. It has to be laid out in a phased manner. So every year, every quarter, every 6 monthly, there has to be certain steps which have to be taken. And this is where we can help them. That look, this is your target which you had set up. It's like a standard costing and a variance analysis system which a company has. You had this target, you had this standard. We measured it over the 6 months, but you are falling short by this much amount, or maybe you have exceeded your target. So keep doing it. Go ahead. Carbon pricing and CERs. The CERs are the certified emission reductions. We all know about the Kyoto Protocol and the carbon credits and all those things. So major corporations and conglomerates in India and all over the world, they have come out with an internal pricing mechanism also. Not only do we have CERs and carbon credits being traded on the commodity exchanges and the carbon exchanges all over the world, but they have an internal carbon pricing. Mahindra is one example which I can give offhand. They have an internal carbon pricing mechanism. So what happens is that just like an internal transfer of materials from one manufacturing unit to the other, one manufacturing unit giving it as an output, and for the second it becomes an in-house input, an in-house raw material. In the same manner, internal carbon pricing is an intra-unit transfer of CERs, so that one generating carbon unit, carbon credit generating unit can transfer its benefit to the other. So how can we help this? So if we have a team which can measure the emissions, and which we can also help in certifying a CER. We can help in measuring the CERs which are being generated, simply because we are continuously on an ongoing basis measuring the carbon emissions made on a day-to-day basis. So once the CERs are established and certified, we can help a company in fixing an internal carbon pricing mechanism, and we can also guide them on going ahead with selling their CERs on an international carbon exchange. This is something which we can advise our units on. Risk assessment for external stakeholders. Now, I earlier touched upon the concept of internal and external stakeholders. Now, if we relate and give an example, sustainability and supply chain advisory would be primarily focused towards objectives of our internal stakeholders. Facility designing, again, it would be for the internal stakeholders. Now, we come out with risk assessment for external stakeholders. For example, we help a credit rating agency. We help them for assessment of ESG risks of a company. We help a bank in conducting, over and above the TV studies, we help them in conducting a sustainability risk assessment for their new credit proposals. So this is a risk assessment area for an external stakeholder. This is something which we can do very well, because we are all trained and grounded into risk assessment since decades now. As practitioners, it has been our academic learning, it has been our practice also. IPO guidance, like I earlier said, IPO guidance is going to be a very, very big avenue, because now all the prospective investors, the financiers, they are all looking at ESG scores, the ESG benchmarks that the company is achieving, the sustainability reporting that the company is making, how committed a company is towards its sustainability goals. This is all going to be a big area. Now, if we would have, I'm going to give an example of point number 9, IPO guidance. LIC is coming out with an IPO. It's a huge IPO. It's going to be a huge IPO. Now, Government of India has already engaged a credit rating agency to come out with an ESG rating for the IPO of LIC. This is just a case in point. This is going to happen. This is happening, and this is going to happen more and more. Valuations. Now, in a valuation of an asset, in a valuation of a business, valuation of goodwill, basically valuation depends on the risks and returns. That is the benchmark principle. Now, when we go into the depth of valuation exercise, the risks are evaluated, the returns are evaluated, we come at a number. It may be an asset, it may be a business, it may be a goodwill. So the risks, when we are assessing them, the ESG risks, the sustainability risks must come, and they must be forming part of the valuations. How much should I discount the value of my target, of my valuation object, because of the ESG risk it is facing? Or on the contrary, how much should I give it as a premium? What should be the premium I should attach for the risk mitigating exercise which a company has conducted or which it has established for the target object? Valuations, the ESG principles, the sustainability risks, it is going to play a major role. And as of now, we do not have, if we go through the valuation standards of all the regulatory bodies all over the world, as of now, it is not spelt in very, very clear terms how to include ESG risk in evaluation, but rest assured, it is definitely coming. It is coming soon. EHS value additions. Now, many industries, for example, pharmaceutical industries, chemical industries, they have EHS safety standards and EHF laws which are applicable to them. They have to comply with them. So EHS, since it is a part of an overall ESG framework, we can help a company achieve its EHS compliances also in a better manner. Next comes the ISO value additions. Companies which have ISO 14,000 series certifications, for example, we can help them that we can tell them, look, you have your own ISO practice manuals which you have adopted. Every 1 year or every 3 years on a periodic basis, an external agency certified by the ISO, it comes for the audit. If you have additional policies and practices in place, your ISO certification either will become easier, or maybe you will be looked at leniently. Your certification, it will carry better value in your market. We can advise people, we can advise our clients on ISO value additions, how to augment their ISO certifications in a very, very nice manner. Transaction advisory again would go to the M&A, mergers and acquisitions, which we had earlier seen. So in each and every transaction advisory deal, if we are brought in, something can be contributed by us in the form of risk assessment, in the form of valuations, guidance on valuations. Now, there is another type of risk which a company is facing, which is coming out of the sustainability risk. Basically, it is the ESG litigation risk. Now, this was completely unheard of earlier, but now it is becoming commonplace. For example, an investor has come in with a condition. I mean, a sustainable finance investor, they have said that you have to achieve so and so targets in the next 5 years, but the company has not been able to meet those targets. So what will happen? That investor, they were committed. The investor said, we came in because you had committed, you had promised, but now we are nowhere. We want our money back, and we are also going to sue you because you did not meet your commitments. So that is one example of an EHS related litigation risk. Those litigations will be definitely conducted by lawyers, advocates, and the legal fraternity. We can be helpful to them by augmenting their litigation skills by our financial risk analysis skills. But this is provided we have a complete understanding of the sustainability framework and the overall market picture at large. Now, coming to the financial statement implications of non-financial reporting. Now, we might have thought or seen that, this is a non-financial reporting framework. What impact does it have with my, what are the implications on my balance sheet? It's just a separate thing, but it is not a separate thing. And as a case in point, I will give you an example. SASB is right now in the process of coming up with standards, accounting standards which will address sustainability risks and their impacts on financial statement elements. How are your assets? How are your liabilities? How are the carrying amounts of assets and liabilities affected by your ESG risks? How are the carrying amounts of your party balances affected? Your stocks, how are they affected by your ESG risks? All this is coming. These standards are under preparation. The SASB is making those standards which will be applicable, and they may be made applicable in India by our institute. It depends on time will tell us, but these things are coming. So we would be, as chartered accountants, in a very, very prime position to address these aspects, because no one understands the balance sheet better than us and the promoter himself. So this is something which is going to be of a very, very prime importance going down the line. I will give you one very small example. As an auditor, you will be going through the director's report, the management discussion and analysis report, the CSR report, and then you come to the BRR and the BRSR report. The company, in good faith, it has got to report that it has so and so sustainability risks. Now, as an auditor, we are supposed to mention in our audit report that whether the going concern assumption is valid or not. Okay. So if we see in the BRSR report or during the course of our audit, we come to know and we come to assess that the company is facing such grave, serious risks on certain ESG parameters that its very existence is going to be impacted maybe 2 years or 3 years down the line. So as an auditor, how are you going to assess and address this risk in your audit report? So my point is that even as an auditor, even if you are not directly concerned with a sustainability practice like I am right now, one has to understand the whole framework of ESG, not in detail, but and in brief, just for a basic understanding of ESG risks and disclosures and its impact on the financial statements. So this is something which is going to be very, very important for our whole fraternity at large, even though we may not choose to specialize in the sustainability sphere, but it is going to be important for us as a fraternity, for the students. And I see a time when our institute will definitely bring this into our final CA course content also. I mean, it is definitely coming. I'm not well versed whether it has brought it already or not, but it is definitely coming. So these are the various practice avenues where we can use sustainability and leverage our practice. Either we may go into one or two, or we may go into all of them. Now, this is basically the end of my presentation. So now we'll take all the questions when we have not had any questions till now.
Can you explain that how somebody like probably me or Karan, who's not basically much directly indulging into the normal practice, how we can approach the client on and get them to work on the sustainability part of it?
Okay. See, like I explained, there are a lot of benefits of sustainability reporting for a company. Okay. So even if you are not into sustainability practice, you can always tell your client that this is what you advise them to do on an immediate basis, because these are the benefits and these are the advantages that you are going to have in the immediate future. If you wish, I can come back again to those benefits. Just hold on. These financial benefits: lower cost of capital, risk mitigation, increase in shareholder value, impact on share prices, positive impact on share prices, higher business valuations, cost reduction, tax benefits. Now, these are something, these are some benefits which any chartered accountant can try and convince his clients so that they can go into the sustainability reporting journey. For that, one must first understand how these benefits are going to accrue to a company. And once we understand that, we can always convince our client that these are the benefits. You go ahead, it will become compulsory maybe 1 year down the line, or maybe 2 years down the line if you are a smaller company for you. But you should go into this, you are going to have an advantage. So better go, better start, and better start reporting. Because the cost of reporting and the cost of preparing all this data is definitely going to be much outweighed to a large extent by the benefits. These benefits are something which we cannot imagine, which can be quantified only once they accrue.
Okay, Vivek bhai, I had this is a technical field in a way, right?
Right.
Environmental reporting. So, and you rightly said many times that it needs a multidisciplinary approach to tackle it. So, if you can elaborate on that, how to make such teams and practical aspects of, since you are working in this field, some practical aspects of those teams.
Okay. See, I'll give you the example of my own practice. We are into this practice since the last 3.5 years. Okay. So since last 3.5 years, I have created a multifunctional team. We all are working together. We have environmental engineers, we have carbon experts, emission experts, we have hydrologists, we have green building architects, all of them mechanical engineers, electrical engineers. We have a whole team. So one has to first find out whether you are in touch with such people or not, because not each and every mechanical engineer, for example, would be interested in working in this sphere, or not every emission expert would be interested in working in this sphere, I mean, in a multidisciplinary role. So what we have to first find out is what type of practice avenue we want to create. For example, coming back to the practice avenues, if we decide that we are going to go only with point 14, that is financial statement implications, okay, of non-financial reporting, then we don't need any multidisciplinary team. We already are capable enough, more than capable of doing that. So as a chartered accountant, we have to decide what avenue we want to get into. If I want to get into valuations, for example, I would need certain multidisciplinary approach. If I want to get into facility designing, for example, as a chartered accountant, I need to quantify the value which I'm creating. For that, I will need a multifunctional team. For example, if I want to get into supply chain advisory, then life cycle assessment, all those things have to be conducted, for which you will definitely need a multifunctional team. So as a CA, you have to first decide which area of sustainability practice you want to get into and which you want to explore. So based on that, you will have to create a team around yourself. Does that answer your question, Karan bhai?
Yeah, partly. So in your experience, let's say, how are clients comfortable when they come? So would they come to you as a CA firm, or would they go to a technical consulting firm when serious? So what is your experience about the same? Since many of the functions overlap, right? Many of the
Right.
areas.
Right. See,
you work in so you work in collaboration with such technical consulting firms.
See, what happens is that whatever we do, whatever a company does, finally it has to be brought down to the base denominator of money. Value also has to be given out in the money form, money terms. Okay. When you say I saved so many watts of electricity, or so many kilowatts of electricity, or I saved so many tons of carbon output, my carbon emissions, what does this all boil down to? It makes no sense in non-monetary terms. So when a client or when a company looks at sustainability reporting and different avenues of sustainability practice, they will prefer either a chartered accountancy firm, or they will prefer a consultancy firm which has commercial chartered accountants or commercial experts with them, because they will definitely need money value attached to the savings that they make, to the practices, because these things will also have a cost. It requires investment. For example, after a study, if we say that you need to replace 1,000 normal mercury bulbs with LEDs, so that is going to give you a big cost of investment. In return, when are you going to reap the benefits of that investment? An engineer would say that you have to go ahead, replace your bulbs. So a valuation expert or a chartered accountant or a person with that bent of mind, with that perspective and background, has to tell them that this is your return on investment, this is your payback, and within next 1.5 years, your electricity bill savings will outweigh the cost of investment. So to answer your question in this context, a client would prefer a company or a firm which has a multifunctional ability to perform an output, to give out a multifunctional output. So that would be preferable if a chartered accountant teams up or associates with different domain level specialists. So this is the overall outlook. And when clients, when our existing or prospective clients, they approach us, they ask us, So we tell them that we have a multifunctional team, so we will be able to cater your ABC 1, 2, 3, 4, 5, 6 needs. So this is how we can add value to your exercise and to your sustainability reporting process.
Sounds good.
Yep.
I think Karan, if you can step in.
All right. If there are no more questions, then I would like to invite our convener of the Professional Development Committee, Mr. Ronak Khandwala, to give a vote of thanks for the lecture.
Thank you, Karan. First of all, let me thank you, today's faculty, for taking us through this new area in our profession. It's quite new to a lot of us, and it was really helpful to have a understanding of concepts like BRSR reports, the concept of how and why of the ESG, the financial, environmental, and social benefits, and the impact of such reporting in our other fields of the professions. And as you have listed out, there are many new practice avenues for all these areas. We need to, as of now, we can choose which area we want to go into, and then actually develop those areas, our interest and the whole expertise in that areas. So on behalf of all the participants and the association, thank you, Vivek bhai, for spending your valuable time with us. And it was a pleasure having you here.
Thank you, Ronak bhai, Karan bhai, and Monish bhai, our president, for inviting me. And thank you to all the participants for sharing their valuable time.
Vivek bhai, if you permit, we would like to share your presentation with all the members of the association as well.
You can please surely go ahead. It'll be my pleasure.
Thank you, sir. And token of love and memento, love and appreciation of the memento will reach to you in a day's time, sir.
Thank you so much for that. And I would request that if our members are interested, because this is a vast ocean, like I said in my presentation. I mean, we cannot do justice to this topic from any perspective or context in 1.5 hours. So if we can have, and if we want to have an extended series, it would be my pleasure to do it. And we can take up and pick and choose each and every topic which is relevant to that time, to the interest of our members. So that can always happen. So please feel free. It will be my pleasure and duty to do it.
Done, sir. Done. We'll definitely look forward to it. And we'll soon have you again with an in-depth topic on the same. And thank you so much for spending this valuable time.
And before we sign off, I would just try to advise all our friends and participants and members that our institute has launched the course on BRSR very recently. Right now, the 8th batch is going on. So please enroll for that course and do it, because even as auditors, we must, like I said, have a basic knowledge of what this is.
Right.
And that is it's a weekend course, 4 hours of learning each weekend on each day, Saturday, Sunday. So just do it. It has an exam also at the end. And it will give a very, very nice primer, a very detailed understanding of the whole BRSR format, which is going to be applicable to all the companies now. So it would be in great interest for all of us to go ahead and do it, if you have not already done it, Mandy.
Right, sir. Right. Noted.
Thank you
once again, and thank you, Karan. Thank you, everyone on the board. We'll be soon out the budget booklet of the association, which is a primer booklet that is published every year. The advance booking of the same has opened up. So kindly, those who want to buy them, please pre-book. this is open for everyone, not only for members, it is also open for non-members. They can also purchase the same. Thank you so much.
Thank you, everyone. Thank you.
Thank you.
Thank you.
Abhi 14 बार हुआ